Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week, people think the AI bubble is popping. We are seeing a broad reset in software and IT services. Big names like Salesforce and Accenture are hitting new lows. Massive AI announcements are shaking the market. Some of them promise huge productivity gains. Others raise real questions about whether certain software tools and consulting services become more valuable or less necessary. At the same time, there are growing fears that corporate tech spending is slowing. Investors are now trying to answer one big question. Does AI accelerate growth for these companies or disrupt their business models? So today, we are going to break down what's actually happening looking at Salesforce and Accenture. We are going to look at what the numbers say and, more importantly, what this teaches us about where the market is heading right now. Let's start with Salesforce. The AI story here will definitely surprise you. Salesforce is the dominant player in customer relationship management software. It's the system large enterprises use to track sales pipelines, manage customer service, and run marketing campaigns. It is increasingly being used to unify customer data across the organization. For years, it has been growing at double-digit rates while expanding margins. But today, the story has shifted. Growth has slowed into the high single digits. That level of growth isn't high enough to justify its high PE multiple, and thus the stock has repriced. Now, management is pitching the next chapter, the Agentic Enterprise. Instead of storing customer data, Salesforce wants to power autonomous AI agents that can take action. For example, resolving service tickets, drafting sales outreach, and automating workflows, all built on top of its unified data layer. They are pointing to trillions of tokens processed and rapid adoption of Agentforce and Data Cloud as proof that this isn't just hype, it's production usage. Salesforce management thinks AI will cause a new revenue growth cycle. Investors disagree and have sent the stock tumbling. But is there an opportunity in this correction? The numbers only tell part of the story. Revenue growth has slowed to the high single digits year over year. That's a sharp deceleration from the mid-teens and 20% growth rates investors were used to. Importantly, most of that growth is still coming from the core subscription business. Remaining performance obligations, essentially contracted future revenue, are still growing at a low double-digit pace. That tells us demand hasn't fallen off a cliff. But here's where it gets interesting for those who doubt AI. AI-related products like Agentforce and Data Cloud are growing much faster than the overall company. Triple-digit growth off a smaller base. Management highlighted trillions of tokens processed last quarter, with customers renewing early to buy additional capacity. There's a big disconnect in how people think about AI adoption. Consumer AI usage and enterprise AI implementation are completely different. Studies that test whether AI can replace an entire freelance job miss the point. That's not how this technology is actually being deployed inside corporations. Instead, AI is acting more like a force multiplier, helping skilled employees complete tasks faster, automate repetitive work, and scale output. In that context, usage metrics like token consumptions actually matter more. So the real question is, does this actually make Salesforce more valuable? Artificial intelligence actually calls Salesforce's whole business model into question. The company charges based on user counts, but if AI agents make individual users more productive, that could slow user growth or even reverse it, as fewer seats are needed to get the same work done. To capture that uncertainty, I'm modeling a forward PE contraction from 23.5 all the way down to 15. I'm assuming 8% revenue growth and a conservative yield of 4%. That gives total growth of around 12%. Net income is still growing quickly, but the potential impact of AI on their core model is a real risk. The result? A projected 12% return over the next 5 years, but also a 36% downside from today's price. My take? I'm avoiding this stock. The AI impact is just too hard to quantify. I think we've covered the risks already. Let's jump straight to the takeaway. Salesforce shows us the AI bubble popping could actually come from AI being more useful, not less. The real bubble pop risk isn't adoption slowing, it's business models changing. Now, let's look at Accenture. We can learn a lot about the future of AI from them. Accenture is one of the world's largest IT consulting and professional service firms, helping thousands of companies modernize operations and adopt new technologies. For decades, it has been the go-to partner for enterprises looking to execute complex digital transformations. Now, Accenture is pivoting aggressively into the AI era. The goal is simple: embed AI deeply into every client business and make themselves indispensable in a world where companies lack the expertise to deploy these tools at scale. The AI numbers are impressive. Bookings for AI projects grew 76% to $2.2 billion, and revenue surged 120% year over year. They have 80,000 AI and data professionals working on AI integration, and they are rolling out custom AI agents that can help with everything from supply chains to insurance claims. But the market isn't convinced. The stock is near its 52-week low as investors worry AI could replace Accenture's services or reduce the need for AI implementation experts. The question is, are these fears justified, or is Accenture positioned to capture massive growth from its AI transformation? The numbers tell a far more balanced story. Overall revenue grew about 5% year over year. Guidance for the full year remains in the low to mid single digits. AI is growing fast, but it's not a large enough portion of revenue to accelerate growth. Bookings came in strong at nearly $21 billion, with a book-to-bill ratio above 1. That dispels demand rumors and shows the pipeline remains healthy. The real issue here is the market doesn't believe companies need Accenture to implement AI and can use AI to replace Accenture's consulting services. The truth is, AI implementation looks easy on paper, but extremely difficult in practice. While many laugh at the title prompt engineer, it is an actual talent to take someone's problem and configure an AI agent to solve it reliably. This is something I experienced myself, where my solution would not work after a full month of trying, while a professional solution did. More companies will realize the fastest way to get up to speed with AI is by hiring experts to help them. Accenture could be a way of taking advantage of the market's misunderstanding of the new AI agent future. Let's see how that plays out in the valuation. The first thing I'm looking at is growth. I'm not going to use the net income growth rate of 10%. I'm going to use the current rate of revenue growth of about 6%. The current forward PE is about 17.5. That equates to a yield of about 5.7%. Combined with the 6% growth rate, that's about 11.7% growth. I don't think that's enough growth for this company, and I suspect the forward PE will contract further to 14. This results in a projected 39% return over the next 5 years, or a 21% downside from today's price before future returns match the S&P. My opinion is to avoid it for now. I believe the outlook is skewed to the upside, but I think this is a name to revisit when it sits at a much better value. One major risk here is shareholder transparency. Management will no longer report the AI growth numbers we are seeing today because they believe AI is integral to their whole business. That's not what the revenue numbers show today, though. And our inability to track this means we won't know when AI hits an inflection point for company growth. The takeaway? Accenture could have been a play on AI expansion. However, with decreased shareholder visibility, it's no longer worth investing in today due to the risk and lack of transparency around AI adoption. While the media says AI is hated, actual use is exploding. Traffic on OpenRouter, a premier AI hosting marketplace, is up more than 15 times over the past year. Salesforce and Accenture highlight the gap between narrative and reality. Salesforce shows that AI agents are gaining real-world adoption, but they could also upend existing business models. Accenture, meanwhile, demonstrates that implementing AI at scale is difficult, and investors remain uncertain whether companies will turn to Accenture for help. The key lesson here is AI is reshaping business models, but investors must separate hype from execution. Opportunities are real, but not every efficiency translates into profits. Understanding exactly how AI affects a business, both upside and downside, is critical. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. I'm sorry I've been gone for so long. I've just had a lot of issues I've had to deal with. I hope you'll forgive me and you still want to talk to me. Thanks. Bye.